Brent, good to see you talking about the headlines today. How to invest when interest rates are cut. Interest rates have been high since March of 2022, but they are finally coming down. That means it's time to rethink how we're investing. So just to start there, can you explain why the Fed is now lowering rates?
Yeah, you got to step back and say, why did they raise the rates to where they're at? So essentially, we had an inflation problem in this country, and so they took the rates up very, very rapidly in 2022. So that was to combat inflation. And so good news for all of our money markets, savings accounts, stuff like that, if you've got cash to invest in those things. But that's also caused some issues. Okay. Mortgage costs are up, things like that. So now they're on the reverse. Inflation is starting to look really good. And so as those numbers improve, they're essentially trying to lower that interest rate to something more reasonable and attain what they call a soft landing, where they don't mess up inflation, but they also don't push us into a recession as well.
And because so many people are concerned about a recession, when do we know if we've avoided a recession?
Yeah, good question. And it's one of those things that we're really not going to know until we get through the next years. Okay.
Yeah.
We'll be able to look back at some point and go, man, yeah, they nailed that soft landing, or no, they pushed us into a recession. And so it's really going to be dependent on how aggressive the Fed lowers rates. And so I think they've been pretty hesitant to do it, but then they came out with a very large first cut. So I think they're going to continue to monitor things, try to do it the best way they can, because the last thing anybody wants is to get pushed into a recession. So we'll get the scorecard down the road, essentially.
Okay. So now let's talk about investing when interest rates are on the decline. What's the biggest difference?
So since 2022, last couple of years, the argument has been, okay, Brent, do I take the free 5% that I can get in my money market, or do I invest those dollars? Well, the argument for investments is over the long run, in a diversified portfolio, 7 to 10% on an annualized basis is, a reasonable goal. Compare that to 5. Well, there's an argument there. Once it goes to 4, once it goes to 3, once it goes to 2, it's going to have more of an argument for that diversified portfolio. And so I think you will see some folks are saying, okay, I'm not going to hold a bunch of cash if I'm not going to earn much on it anymore. I think it's time to move into some more investments.
I'm going to miss my free 5% at the bank.
Oh, yes.
Yeah. So now let's talk about then some specific investments that we should consider now that rates are on the decline. And first you say small cap stocks, high yield investments, bond ETFs, preferred stock, REITs or real estate investment trusts, and last, housing stocks.
Yeah, I love the list. We could add a couple more to it. I'm glad you brought up this question, because there is no magic answer on what you should invest in. Once again, when we meet with clients, it's based on goals, concerns for what we recommend you would invest in. So different people are going to have different answers. Those are all great options. But one thing that I think there is, an overall positive thought on is small caps stand to benefit the most from the interest rate reductions. So what that will allow is cheaper money to borrow. Small caps are comprised of smaller companies who needs money to get up and running. So I do think that in the short to midterm, small caps are going to see a nice bounce from this. And so it's good news for those investors who own those positions.
Well, Brent, if somebody then would like a closer look at their investments with you to make sure they're well positioned for this rate decline now, what's the best way to reach you?
Yeah, 614-430-8383. Just give us a call and Becky will get you scheduled, or go to young-wm.com. We'd love to chat about it.
Great. Brent, thank you.